together, Dad, sorry, music, where investors pool their money together to buy different assets. It is managed by a professional, or we'll talk a little bit about the concept of index funds because those don't have any managers, but it's managed by a professional, and the assets that are purchased in that mutual fund is in alignment with what is called the prospectus. So every single mutual fund has a prospectus document which tells you how that financial manager or financial investor is going to invest the funds or for the mutual fund. Okay? Make sense? All right, so the way that mutual funds work, a bunch of investors, you pool your money together, you have a fund manager who says, oh, we have all this money, let's go buy stuff. They go choose the funds in accordance to the prospectus, right? So take, for example, you have a mutual fund that invests solely in REITs. So they only invest in real estate assets. You can have a mutual fund that solely invests in defense companies. So they invest in people like Boeing, Lockheed Martin, etc. So you know how they are investing the money. So they invest the money, they purchase the securities / assets, they generate gains, you realize the returns, okay? The returns, you'll see it in two ways. It's either the price of the mutual fund is going to go up, and some of them pay out dividends. So they'll give you dividends. Now, there are two things whenever you typically purchase a mutual fund that you can do with the dividends. You can take the money, or you can use the money and you can reinvest the money back into that mutual fund. So then it becomes a closed loop. All right? So investors pull your money, they buy stuff, you make money, they give it back to you. Make sense? All right. So if you look at the benefits of a mutual fund, it diversifies you from high risk equities. Whenever you have any person who is not a professional investor, I always recommend that you go through a mutual fund. It will diversify your risk. So let's say you were invested in a mutual fund that buys assets for defense companies. When Boeing cratered last year because of everything going on with the 737 MAX, you would have seen it go down a little bit, but it would not crater as hard as if you were to have just invested in Boeing stock. And that's because they have other investments in there that protects you from exposure to just one asset, okay? So that's one of the benefits of mutual funds. You can purchase assets which would be otherwise too expensive for you. So remember we looked at BRKA, you need $343,000 just to buy one share. Well, maybe I want to invest, I want to have some exposure, meaning that I want to somehow be invested in Buffett stocks, right? He does have a Class B stock, but let's just pretend like the Class B doesn't exist, right? So what I can do is I can buy a mutual fund that invests in the BRKA. And that way I now still am invested some ways in Warren Buffett stock, all right? You can rely on the investment expertise of financial managers, and I put an asterisk there, and we'll talk a little bit about that why. And then you also get dividend reinvestment payments. All right, this tends to be the hardest concept. I'm not sure why, but I'm going to try to do a good job explaining it. Now we're going to talk about index. So there is index, and then there is an index fund. An index is basically a set of rules of how to construct a portfolio of holdings. It's just a set of rules, okay? You might have the most popular indexes that you hear of all the time is the S&P 500, the NASDAQ, and the Dow Jones, okay? Those are indexes. I want you guys to get that. Those are indexes, all right? What do those indexes mean? The S&P 500 is a stock market index that follows the 500 largest companies in the United States, all right? So, and when I say 5 largest companies, it's not based on revenue, it's based on market capitalization, All right. So it follows the 500 largest companies, and typically what you tend to see is that whenever a company is now part of the S&P 500, you'll see their stock price go up. All right. The NASDAQ, this is a composite index, and this index basically tracks the companies that are in the NASDAQ stock exchange. So NASDAQ is a very confusing term because NASDAQ can mean an index, and NASDAQ is also a stock exchange, okay? The stock exchange, whenever a company lists their company or their public, is like, this is traded, like Pros is traded on the New York Stock Exchange. I think Apple is traded on the NASDAQ, I can't remember. But it honestly doesn't matter where they're traded, but the only thing that matters for you to remember is that when you're investing in a company that is that's in the NASDAQ, right? Or you're investing in a NASDAQ index fund, they'll tell you'll hear terms that says the tech-heavy NASDAQ. And that's because it's primarily made up of tech companies. So the NASDAQ is very tech-heavy, all right? And then the last one is the Dow Jones. The Dow Jones is a measurement of 30 large publicly owned companies. People talk about the Dow Jones a lot. It's just 30 companies in random, okay? I want y'all to remember that. And the people who select the 30 companies, it's like I took a class at Rice University, and they were like, they're out in Australia or something like that. It's very arbitrary, and it's also not weighted. I'm not going to go into what that means because we don't have time. Whenever people talk about the performance of the market, they're typically talking about the S&P 500. I want you guys to remember that. And the reason why is that whenever you're looking at how well is my portfolio doing, meaning that how well is all the assets that I have doing, I tend to look at the assets in context to the S&P 500. So if my portfolio is outperforming the S&P 500, I'm like, okay, I'm not doing bad. If my portfolio is significantly underperforming the S&P 500, then I start to ask myself questions. All right. The second thing to also note with the S&P or with mutual funds is that every mutual fund that has a professional manager has an underlying index fund that they're tracking, okay? Now, when I'm not saying that they're tracking, they have an underlying index fund that's a benchmark. So they might have an index fund that is tracking the S&P 500. They might have an index benchmark that's tracking the S&P 500, that's tracking something else. And I'll show you guys how to tell. That's how you can tell the performance of a mutual fund. If that mutual fund manager is doing well or if they're not doing well. It's how well are they performing relative to their index benchmark. Okay? All right. So passive versus active investing. So passive investing is when you invest in a mutual fund or in a fund that tracks an index. Whenever you have an index fund or an index fund, you don't have a professional manager. An active mutual fund is when you have a fund manager. You have somebody who's physically there making the decisions on how the money is being used. They can make the decision on when to buy, when to sell, etc. Okay? And their goal as a fund manager is to outperform their benchmark. Remember, every single one has an underlying benchmark that they track. It's how well you know, or it tells you how good that fund manager is, right? So I've looked a little bit, put a little bit of some of the advantages and the disadvantages. So when you look at index funds, there's little turnover. They have low costs. There's a lot of transparency, and they're very tax efficient. And the reason why they're tax efficient is because there's less turnover. So when a mutual fund manager sells a stock at a profit, you will get hit with some taxes, in some ways. So that's why they say that it's not efficient, because you might not want to pay taxes, but it's going to be at the discretion of the mutual fund manager. The disadvantages is that there's limited options, and there is also low turnover. With an active management account or with a mutual fund that has a fund manager, they're actively managed, they're flexible options. They can implement maybe risk strategies, meaning that right now that there's coronavirus scare, maybe they decide that they want to sell 10% of their assets or whatever and just sit on cash, or maybe sell 10% of their assets and buy bonds. They can do that because it's actively managed, whereas in the mutual fund, you cannot do that because there's nobody managing that index fund. Okay?
Let me ask you this.
Yes.
Is anybody working on an
I knew you were going to ask that. They do. They actually do have robo-managers.
Because you see, you and I, we can only take in so much info, so much data, but then with this AI, I mean, it can take in,
Yeah.
you know,
Yeah, and the short answer is yes, they do. They actually are now, they have mutual funds that have robotic fund managers, and they also have portfolio management system, because one of the things that you can do is that you can say, I don't want to manage my retirement account, or I don't want to manage my portfolio. I'm going to get a financial manager. So I'm going to give Fidelity and tell them to professionally manage it. So there's an option. Whenever you do that, the costs are high. They're probably charging like 1% you'll hear it called revenue under management, or it's not revenue under management, that's us, assets under management. So they might say, okay, you have $250,000, so we're going to charge you 1% of that, and they send out the bill. I can't remember if it's quarterly or twice a year. I can't remember. So they basically do that. But then there's a middle option now, which is not as expensive as a professionally managed account. It might be at around 0.45, and this is where you have like robo managers. So you actually have an AI system that's doing the implementation of how to manage your account for you, and you just have somebody that oversees that. So yes, they do have some of that.
Just to follow up on that, is there a comparison of relative performance?
That's a great question.
What
Yeah.
the AI is doing and what
Versus, so there hasn't been, I haven't seen a lot that is comparing what the AI systems are doing. But one of the things that I was going to ask you guys, so based on these two, right, which ones would you think would perform better long term? Index funds or actively managed accounts?
Index funds.
Index funds? Anyone?
Actively managed, I would say actively managed.
Index funds.
Actively managed. It's actually index funds. It's overwhelmingly index funds. Wow. So here's what tends to happen. So this, I pulled this, say that again. So what this tells you is the number of fund managers who underperformed their benchmarks for the last 10 years. And you can see with large cap, remember large cap are companies that have over $200 billion in market capitalization. 85% of managers who invest in large cap assets underperform their index. Small cap, mid cap, they underperform. And here's why. Because it's human nature. Here's what we tend to do. One of the key things that I talked about in class 1 was how you can never time the market. You cannot time the market. So you see here, like, coronavirus is happening. So what people will do is that they'll sell their assets. Like, they freak out and they sell their assets because they want to wait for the market to bottom out. When is that? They have no idea. So all you do, you might let it slide a little bit, but people tend to sell their assets. And as the market is going back up, because the market doesn't go, it's not linear. It's not like, oh, look, I'm going up now. Oh, look, I'm going down now. It'll do this and, all this. And so you just never know where you're catching it, right? And so because of that, you'll sell at a low point and maybe you buy at a high point. Sorry. So because of that, you don't know. And that's why a lot of people tend to underperform an index. So that's why I always say that when you invest, set it and leave it. Even with coronavirus, look at last year. I don't know if you guys remember because 2018, the market lost money. The market it shrank. And a lot of people were talking about how we were going into a recession in 2019. You know, everybody sold their assets. You know, Trump has done this. The trade war is coming. You know, companies are going to be reporting loss. 2019 was the best year over 10 years. 30% growth. So can you imagine if you had sold your assets, right? You would either miss out on this run or you would have bought in back in 2019, maybe in April, maybe in May, once you know you're not as hesitant. So you never know what the market is going to do. And that's why it's better for you to buy an index fund.
Me, in my layman thinking, I'm like, don't depend on the market for your 1 year, 2 year financial sustenance.
Yes.
You know, like you said in the first class, have that ready, have the savings, and when it goes up, then you can get your money.
Yeah.
When it's down,
Don't touch it.
Don't touch it.
I don't touch it. I'm like, I was telling my dad when we came in here, so I don't know if you guys know, on Friday, the market crashed hard. Like by I think the NASDAQ was down almost 2%. I told my dad, I was like, I didn't even log into anybody's investment account. I don't want to see it. If I see it, I might be like, ooh, like, I just don't want to see it. And I know it's there. But since I don't need the money, and we'll talk about that, right? But because the biggest thing with investing, especially when you're doing the market, never invest money that you need within the next 3 to 5 years. If you need the money, do not put it in the market. You don't know where you're catching the market, if you're catching the market on an upward trajectory or a downward trajectory. So just do not invest money that you need in the next 3 years. Yeah.
I just wanted to make an observation concerning the index funds and the managed funds. You know, it depends on the individual fund managers.
Yes.
I know fund managers that they've always outperformed the index-linked funds. You know, for a long time. I can name one or two. You know, Arenimo is one of those. You know, and they just do so well. You know, because they know their peaks. You know, so it depends on.
So here's the thing, right? It does depend, but you might be able to pick one. Like, so the reason why Warren Buffett became so popular, right, a few years ago was because he was able to generate returns upon returns upon returns. Warren Buffett will tell you himself it's very hard to beat the index.
Yes.
And they've actually now, primarily, what people don't realize is that a lot of these fund managers also invest in indexes.
Yeah.
They do. So you might have one or two who you'll find who do it consistently, and I'll show you how to see them, because I do have index funds. I primarily invest in index funds, but I also have some actively managed accounts. But that's because these guys have been able to consistently beat the market. But that's an exception. It's not a rule. Yeah. So, all right. So tip number 4, focus on investing in passive funds over active funds. Why? Long term, they do better and they're cheaper. And we'll talk a little bit about the cost, because part of what you've got to look at is that when you're looking at a return, you take however much they might net you. Let's say they have 10%, right? Or 10% return year over year. Let's say 10% for 2020, right, or 2019. If it costs me 2%, my net gain is only 8%. Okay, so that's why the cost is very important for you to pay attention. I don't invest in any mutual funds that have over a 1%. That's even 1% is really high. I think the highest one I have is like 0.76 or something like that. 0.76 or 0.86. So, all right, let's read a mutual fund. It's gonna be a fun exercise. Can somebody remind me FADMX? All right, perfect. Let's go. So I actually have, I asked them for a dummy account so you guys can see what we're talking about. Okay, so for those of you guys, I have Fidelity, so I'm used to looking at Fidelity. This is the same way you would read it in any brokerage account: Fidelity, E-Trade, Vanguard, Schwab, whoever it is, right? It honestly doesn't matter. So let's look at this. So FADMX. So FADMX is the ticker Okay, so this is the ticker for the mutual fund. So let's go in here. All right, so this has lots of information. So you see here it says, the title of it says, oh, sorry.
I was looking.
I thought y'all were looking at everything that I was seeing. Sorry.
Do you need me to?
Nope, I got it. Can you see now?
Yes.
Oh, this thing got smaller. Oops, all right, too big. All right, y'all can see well? Okay, perfect. Okay, so you see here the title of this mutual fund is called the Fidelity Strategic Income Fund. So that almost kind of tells you a little bit of what it is. When I read a mutual fund, you can look at the overall rating, and all that, but I tend not to focus too much on that. I'll look at first the performance. So you see year to date 1.8. For the past year, it's 8.3, 5.2, 4.55, 10 years, right? So I'll look at the performance of it. The next thing I'll look at is the cost. So hold on, sorry, before I look at the cost, you see here, it says that it's a bond fund. Does that make sense? You guys see that? So that means that they are investing primarily in bonds. And that's part of the reason why these returns are 8.3, 5.1, etc. All right. Then the next thing that I'll look at, right, is the expense ratio, 0.69. Not too bad, but as soon as I see 0.69, you know what that tells me? It's not an index. They're fund managers here, right? So because indexes tend to be less than 0.0, when you see 0.0 something, that's an index. You might see 0.1 a very rare occasion, but it's more 0.0 something from a cost perspective means that it's an index. All right. So I'll look at the expense ratio. So it's 0.62. The next thing that I'll look at is what are the top 10 holdings. So you see here, the number one is U.S. Treasury notes. All right. So they're investing in what looks like investment grade bonds. All right. And if you read the prospectus, it will tell you. All right. Then the next thing I'll look at is the fund managers. The reason why I look at the fund managers is you want to understand who is responsible for the returns that you're seeing. Okay. If I go all the way to 10 years, right, and it's 5.17, right, in 3 years, 4.55. I look here at the fund managers, okay, 10 years, 2012, okay, so he wasn't responsible for the 10-year, right, because he hasn't been there for 10 years. Does that make sense? Mark, okay, 99, all right, so he's been there for a while. Okay, 2002, okay, so he's been there for a long time. So I know that there are some fund managers here who are actually responsible for the returns of this fund. That's very important and something I never thought about until I took the class, and they were telling me that you've got to look at who the fund managers and their tenures. And then the last thing I look at is where's the index? Here we go. All right. Remember I said every mutual fund that has an active fund manager has an index fund that's the benchmark. All right. So with this one, the benchmark is actually the big, this whatever that is. You guys can see it, right? All right. So here is the benchmark. And you can see that they're actually outperforming their benchmark. Not a lot, but they've outperformed their benchmark. So they've outperformed their benchmark. There's this, and there's the strategic income, complex index. Sorry, this is the actual benchmark because you see it says index. So in either way they've outperformed their index. But remember, the cost is 0.69, right? So 0.69 or 0.6. You have to look at it, and it's like they're basically kind of on track with their benchmark. And in some cases, they're a little bit lower than the benchmark because you have to take into account the cost. Does that make sense? Did you guys follow all that? Yeah. So that is how I would read this. All right, so you see here where it says the fund overview. This is a summary of what I call the prospectus. I don't necessarily read into it because by the time I look at it, I already know what sector it is. So this is a bond category. All right? And here I can buy, I can sell, etc. So you see here it says prospectus. If you want to read the entire document, it's a long document. Feel free. Yeah. Oh, yes.
The value of a mutual fund, can you calculate it and compare? I mean, if you know all the different percentage composition, maybe.
Yes.
Can you calculate and see, hey, is it overpriced? Is it underpriced?
Oh, like that. You like having a PE ratio?
Yeah.
That's a
Because it's a composite of multiple different
company, yeah, entities. You can't, I don't know how to actually calculate the value. I think there's an answer to that, but I don't know what it is off the top of my head. I mean, the one thing that I would say is that you can tell how much funds these people are managing. So they basically have $16 billion in assets. And each share is basically about $12. So that's what I can think of, but I don't know the value question. I'll have to check that. Any other questions from somebody else?
You said it's outperforming the benchmark. I think I'm not seeing what the reflection is.
Oh, it's barely, and that was only in year one. So here, so this is the fund. That's the performance of the fund, and this FID strategic index complex or comp index. That's the index fund. Yes, 10.56, 11.04. So, but you have to take this 10.56, yeah. So, yes, 0.69 because it's 0.69 to actually invest in this.
So you're actually doing better.
With the index.
I was looking at the figure on the top.
Yeah.
The 8 point, whatever was there.
Where? Which one?
So 1 year, 3 year, 5 year.
Oh, that just tells you the performance of the stock. Yeah. The other thing that you guys need to remember is you need to check to see if there's a minimum amount to invest in the asset. So here there's no minimum. But sometimes they might have a minimum of $2,500. That means that the minimum you can invest in that mutual fund is $2,500.
How would you know what the benchmark is? Like when you scroll down and you saw that,
There are two.
it's buried. It's
Yeah.
buried and they don't use the word benchmark. They don't,
Yeah.
it's, whatever, reduced to an acronym.
They typically, you have to look at it. So even in this chart, I didn't show you guys here in the chart. So it shows you the purple line. It shows you the performance of the company, and then it shows you here's one benchmark and here's another one, right? So you see they're closely tracking the benchmark, but that's you just have to honestly look at it, and it tends to be.
You learn the vocabulary.
Yeah.
Even 2018, well, this is a dummy thing, but
No, this is a dummy account, but that's a real fund. Okay. You see the name here? Fidelity 500 Index Fund. All right, so this is an index fund that follows the S&P 500. So you see, Amir, your question, you see here it says S&P 500. It basically is identical. This just says large blend, but I can't even see the difference between this fund and the S&P 500 because it's an index fund for the S&P 500. So you look at the returns, right? 1 year, 3 year, 5 years, 10 years. That's how well the S&P 500 has performed over time. All right. The other key thing, right? Remember when I said that you see whenever you're in an index fund, you have an expense ratio that's like 0.0 something. As soon as you see that, it's an index fund. All right. There's also no minimum amount to invest here, so you don't have to invest. You don't have any minimums. And then the other thing that I was going to tell you guys, they don't show it on here, but sometimes you'll see a fund that requires a load fee. I'll stay away from them. Don't do it, because most of the times it's not worth it, because that's just another fee. So whenever you're trying to maximize the amount of money you're getting back, right, at the lowest cost to you. So you don't want to be paying all these extra funds. So if you have or extra fees, let's say you're investing $5,000 and it has a 10% load fee, right? That's $500 that is gone. So you're really only investing $4,500. So you just got to be careful with that. So
Can I ask you a question?
yeah.
Turnover rates, what does that refer to?
Oh, perfect. Great question. That means the turnover rate is how often the manager of that fund sells an asset and buys another asset. So on the other one, you saw it had a high turnover rate, like 60 something percent. On this one, it has 4%. That's because remember one of the things we said, that index funds are tax efficient. So you really don't turn over unless there is a change in the underlying index. So when ServiceNow now joined the S&P 500 and one of the companies dropped off, all it would do is just buy assets for ServiceNow and reduce those assets for that other one. Make sense?
Can I
Yeah.
just ask one quick question? So,
Yes.
So how do you actually decide on choosing any of these funds? So what are they, would I have to open up an Excel spreadsheet and just put figures, or is
Yes.
there a more efficient way to actually
No.
compare?
So I'll show you how you figure out your asset allocation. So all right, so here you see these are the top holdings of the company of this this index fund. Apple, Microsoft, all the ones you recognize, right? Top 500 companies. So and it's by market cap. So Apple is the most valued company in the United States. So you see they basically are by market cap. The other thing you see here is that fund managers, Geode Capital Management. Index funds don't have managers. That's why it's just the Geode Capital Management.
So on this report, you have the top 10. Do you have anything like the ones that, like the top list that you run away from? You have top 10 holdings that you can buy, right?
No. These are the top 10 holdings that are in this index fund.
Okay, that's fine.
Yeah.
My question is, do you have a list that,
Of funds to stay away from.
No. So these are, so when you say the funds to stay away from, so what you have to remember and the reason why with what you said is that there are two different concepts. So you're talking about stocks that you shouldn't invest in because that's a different concept than this. This is in this mutual fund or in this index fund. Here is the asset allocation in this fund. So these are the top 10 holdings, and these top 10 holdings represent 22% of the portfolio. Okay, so that's different than here's some assets that you might want to purchase or not. You guys following this? Okay, let's do one more. I told you guys I would show you the REIT. FRESX. See what it says? Fidelity Real Estate Investment Portfolio.
Sorry,
Yeah.
maybe this is a bit more. Do you have as much flexibility when you're trying to purchase a mutual fund, Like, if you trade in stocks, for instance, you can set target prices.
Mm-hmm.
You can put limits. You can put trailing.
That's a
limits.
great
Can you do
question.
all that in
No.
mutual funds?
So that's a great question. So the short answer is yes and no. The reason why is that with mutual funds, the what do you call it? The order executes at the end of the day at whatever that fund price. So I can say I want to buy, and with mutual funds, you're not saying I just want 2 stocks or 2 shares of this mutual fund. You say I want $10,000 worth of this mutual fund. And whatever $10,000 worth is, that's what they give you. So with mutual funds, you will see fractions of shares. So you'll see 237.58 shares is what you have, because that's what $10,000 worth. So it's not treated like an individual stock. However, the reason I said yes and no, so mutual funds, that's how that works. We're going to talk about ETFs. An ETF is an electronic trans something fund. Yeah. Thank you. I was like, what am I saying? So electronic traded fund, it's basically a mutual fund that trades like a stock. So it has a stock price, and you can do everything you want. You can set a limit. You can set, it trades just like a stock. So that's why the answer is yes and no. All right, so this is the last one we'll take a look at. So this is the REIT mutual fund that I invest in. So as you can see, this is actually an actively managed account. So you see it's a 0.74. You see the returns of the REIT over the last few years, right? So this year they're actually doing well. Last 1 year it was 14.4. And remember, a lot of this is based on the dividend that you're getting back. So if I go down, remember the key thing to check is the fund manager responsible for the performance? This guy has been there since 1998. He is responsible for the 10-year performance. Makes sense? All right. And then the other thing you see is that these are the top holdings. So you can see these are all REITs. It's telling you there, right? Majority are REITs. Some of them are properties, but a lot of them are REITs. And then the last thing to see is the performance. So you have, the performance here is not the S&P 500. So you see it says S&P 500, but that's not, this is a real estate fund, right? So the index fund is this DJUS Select Real Estate Sector, right? So you see how it's tracking 25.2%, 23.10. Remember, this one has an expense ratio of, what was it, 0.7? Yeah, 0.7 something. So it actually is performing a little bit better than the index. But this is what I'm telling you guys, that it's very hard to beat an index. Do you see how these guys are performing based on their benchmarks? So it's not easy. That's why a lot of people just tend not to even bother paying for. Yes, they just invest in an index fund and you call it a day.
The challenge is that you just think you're going to do better.
Better, yes. And that's a problem.
So you look at the fund managers because you want to know whether those guys responsible are still there?
Yes.
Okay.
Yes.
So if they're no longer there, you stay away.
Yes. So there are some funds that you'll see like 20%.
Take the risk, yeah. Take the risk.
You can take it. You take it, exactly. So if somebody is just there 2 years, right, they're not responsible for the 3-year performance or the 10-year performance. So you at least know, right? All right, so let's hop back. Yeah.
One last question. It's pretty easy to get from the markets what the best performing stocks have been in the last 1 year.
Yes. Yeah.
Right?
Yeah.
Is it possible? Is there anywhere to compare mutual fund performance and see, okay, what's the best performing mutual fund?
I'm sure there is. I don't know where, but I'm sure. Oh, you mean best performing mutual funds out there?
Yes.
Oh, yeah. That's easy.
Yeah.
So in a lot of your brokerages, you can actually do fund research. So remember, the reason why a lot of people don't do fund research because you're in a 401k plan. In a 401k plan, you don't have the flexibility. They give you 30 mutual funds and you pick from those 30 mutual funds. If you have an IRA, if you're doing individual investments, you can actually do research on your own. So you can come in here, you can research, and it's overwhelming because you can find whatever. I can say, okay, I want you to show me funds that have an overall rating of this with this. Fidelity funds only. All right, let's see. Let's see the results. So here you go.
You can see the 1, 3. Oh, perfect.
Yeah. So you can find. Yeah, but then see, here's the one thing you need to be careful of. Part of the reason why, and I have a slide in here, but we'll talk about it now. Part of the reason why you need to look at the top 10 holding is because you don't want to concentrate your portfolio. You can buy 2 funds and you're like, oh, I'm diversified. But those 2 funds, exactly, they're invested in the same thing. So you're still concentrating your portfolio. So you need to be cognizant, and you need to watch what assets you are investing in, or you need to see how they're invested in. Because I made this mistake, and I was like, oh, I'm just going to select these 3 funds that have a lot of the greatest returns. Well, here's what happened. A lot of the great returns over the past year have been tech stocks. People who invested in Amazon, Apple, etc. So my portfolio then became really, really concentrated. So when the market tanked, I was like, what's going on with it? Only to find out that although I thought I was diversified, I wasn't really diversified because I was investing in mutual funds that had the same assets. Make sense? All right, fantastic. All right, so let us go back here. Okay, so what are some reasons or what are some important things to remember? This is just a summary. So minimum investment amount is going to tell you if you can invest if you have the minimum amount. A lot of them are 0. Some of them might be 2,000. Some of them might be 2,500. What are the costs? So remember to always try to keep your costs low. What are the top holdings? What are the returns? How is a fund performing in relative to its benchmark? Who are the fund managers and how long have they managed the funds? All right, and you guys will get this slide so you can take this and reference this as you select your own your mutual funds. All right, so one of the things to remember when you're buying a mutual fund, you're buying the performance of its portfolio. So the portfolio appreciation. We've talked about the fact that it's got an underlying index, expenses, investment amounts. We talked about the fact that orders are executed at the end of the day. So I can say today I want to buy $5,000 of FRESX. That is the REIT fund. That is going to be executed at the end of the next trading day, not in the middle anywhere. That's why you'll see them send you the notifications. I don't know if you guys get them, but I get them from Fidelity at the end of the day. All right, ETFs. So this is what you were talking about. So ETFs are a basket of securities that basically trade like a stock. So what I actually have in my parents' accounts is that I don't invest them in mutual funds. I invest them in ETFs. For every mutual fund or index fund, you can find its ETF. And and part of the reason being is that sometimes when you're investing, like FRESX is a Fidelity fund. If you don't have a Fidelity account, what they tend to do is that they will put additional costs because you're not with Fidelity, you're with like Merrill Edge to be able to invest in that index or in that mutual fund or index fund. So what I do, instead of paying for that, all I do is I find the, the ETF, the relative ETF that corresponds to that index, and I just buy the ETF. Many times it's cheaper. So let me give you an example. So David, my younger brother, wanted to buy a Vanguard total market fund or total market index fund. And the total market index fund is a fund that tracks the total market. All right, so it gives you the average returns of the entire market. Well, he was trying to buy it and he was like, this thing's not working. Why is it not working? Well, I told him, I said, the minimum investment amount was either $2,500 or $5,000. He was like, I'm not investing that much in that. So I said, okay, let's go find the ETF. We're able to find the ETF, and I think the ETF was like $300 per share or something like that. And you literally can have that execute like a stock. You can put in a limit order to say, okay, I don't want to buy at 300. If this ETF gets down to $250 or $275, I want you to buy 10 shares. I want you to buy 20 shares, etc. So it trades like a stock, and it trades throughout the day. So one of the other things that people say you can benefit from is that you can benefit from the fluctuations in prices throughout the day, whereas with mutual funds, you have to wait to the end of the day for it to execute. Make sense? All right. That was the break. Imagine, that's how far behind we are. All right, let's talk a little bit about stocks. I was going to do a stock exercise, but because of time, I'm not. I want to jump into the strategy section because I believe that that's probably more important. No, but that's true. So the reason why I have this here, because I want everybody to think about that with regards to if you want to buy individual stocks. I always recommend that you reduce your exposure and you buy mutual funds, index funds, ETFs, etc., because that reduces your exposure, right? But if you do have a riskier appetite, right? You can invest in stocks. Like I have a 401k, I have a traditional IRA. All of those are mutual funds well, not all of them. A lot of them are mutual funds and also index funds and REITs. But I do have stocks in there. In my personal account is all stocks, but I also know the kind of exposure that I have. And I don't invest in a stock that I'm not comfortable holding long term. Because remember, one of the things that I'm going to say is that you want to invest, you want to make sure you're not putting money in the market that you need in the next 3 years. You don't know when you're going to catch the market. But over time, it's going to go up, but it might go down for a little bit. So that's why you want to make sure that you're investing in an asset and not following a trend. All right. If you really want to buy Tesla and you believe in the EV market and you believe you want to hold Tesla for the next 20 years, have at it. You know, but if you just want to capitalize and get that quick 20% because they're appreciating 20% per day, just be scared. All right.
And Loretta, the other point to make is that it depends on where you are in the life cycle.
Yeah.
Your own personal life cycle. So if you're a 70-year-old.
Yes. Don't buy them. Please tell my father that. Tell my father.
I take that back,
Tell my father that.
I'm just saying, because I'm thinking about myself too. I'm thinking,
Yes.
What's my risk averseness?
Yes.
In this situation, because,
Yes.
yeah.
All right, so we're gonna go past. I'm not gonna do the stock reading exercise. They're typical things you need to understand when you're executing a stock limit, but I won't go into that. This is for anybody who actually is in a publicly traded company that has ESPP. It's a guaranteed investment. I don't use the word, you know how I am adverse to using the word guaranteed. ESPP is guaranteed if you sell immediately. So ESPP stands for Employee Stock Purchase Plan, okay? And what happens is that they give you the stock at a 15% discount or at some discount. Yeah.
You already made 50%.
Exactly. So if you made your 15%, take your 15% and run. If you want to take your 15% and be like, I believe in the long-term trajectory and hold it, you open yourself to a little bit risk. But in the first class that I taught, there were a lot of young people in there who worked for public companies, and I told them, when I was younger, I used ESPP as a way to save money. Because what you do is that you put money in that account, I can sell it, I can get the gains, I can take that portion of money, and I can throw it into my savings account. So it's a good way to create the discipline of saving money. Yes. So you get taxed, and we'll talk a little bit if we get to it. We'll talk about taxes. So when you execute a stock sale, there are two taxes. You either pay long-term capital gains or short-term capital gains. Short-term is if you hold the asset for less than a year, and that is just taxed at income. When I say it's taxed at income, it means that it just goes the same whatever effective rate that you're paying for your income is that's what you're gonna pay for this stock. Whereas if you hold it for over a year, it's either taxed at 15% or 20%. 15% for the majority of people because your income is less than $434,000. If you're over that, then it gets taxed at 20%. So, all right, so let's talk a little bit about strategy. So when it comes to investing, you want your money to grow at the highest rate of return with the lowest risk possible. These are what I call the big D's of investing: discipline and diversification. You have got to have discipline. So discipline is the act of putting together an investment strategy and sticking to that strategy. Here's what tends to happen. They actually have they have an index that measures the amount of fear in the market versus the amount of greed in the market. Fear will make you sell an asset before you need to sell the asset. Greed will make you keep an asset longer than you need to keep that asset because you keep thinking to myself, well, maybe it's going to go higher, maybe it's going to go higher. Fear is like, oh my God, it's going low. I don't want to lose any more money, so I'm going to sell now and get out. So you need to have a strategy to figure out what do I want to do with this asset? What are my goals with this asset, right? The other thing you need to make sure you don't do is you're not going to, don't time the market. You will miss. Even the most brilliant economists cannot tell you what the market is going to do. Everybody's going to say their own predictions, but they have no idea. Oh, I was going to tell you about some of my hardest lessons. Let's see, which one should I tell? Let me tell you about the one that I put the question mark in because I honestly can't remember the name of that asset. When I started investing, so I invested $5,000 initially in two assets. I've invested in Apple, I've invested in Amazon. The one most painful, the hardest lesson that I've ever learned was actually in the one that was question marks. So here's what happened. I have a friend who was investing in, I don't even know, I use that word loosely. He was watching the market. And there was a stock, yes, he was watching the market, and there was a stock that kept growing 20% day to day. So he sent me a message and he was like, yo, this stock is appreciating 20% day to day. I was like, I have $5,000. I can just make a quick $1,000 because it's 20% day to day, and I can just, sell at the end of the day once I get my 20%. Of course, the day that I put $5,000 in the market, can I tell y'all I lost $1,500 in hours? Hours. I took the $1,500 loss, and that is the last time anyone can get me to invest in an asset that I did not understand, because I will tell you guys, never invest in what you don't understand. Whenever you see anything going up by 20%, 20, 30%, remember I told you that the biggest indicator of your risk is not how much you're willing to make, but how much you're willing to lose. At that point, I was not willing to lose $1,500, but I did. I was young. I was, and that's a prime example of greed, right? You saw it, you're like, I can get in, make a quick $20 or $1,000, and that's what people tend to do. And by the time you get out, you've lost money instead of actually making money. So I love this quote by Warren Buffett. He says, be fearful when everyone else is being greedy. And when everyone is being greedy, when others is being fearful, that's when you become greedy. So literally, what that tells you is that when assets are flying sky high, like Tesla, Dad, when assets are flying sky high, because to me, it makes no sense why Tesla is valued at $900 and something. That's to me, that's greed. So guess what? I'm not touching it. But if you have assets that are tanking, right? The whole market is tanking right now. I told my dad the last time this tanked, I was like, oh, I'm about to go shopping, right? So you can buy assets that are basically tanking for cheap because most people are afraid. That's how he made his money. Okay, so this is one of the things you need to. It's hard to have that response, but you need to train yourself that when the market is low, that's a buying opportunity. When the market is high, you need to evaluate and say if you really want to buy at that point.
But again, you still have to be very careful as well,
That's true.
And they go,
And they go, yes, yes. So they have an expression that says, don't catch a falling knife. So if an asset is tanking, a lot of times it's tanking for a reason. So you need to figure out what that reason is, and is that something that the company can turn around. But this is part of the reason why I always say invest in funds, invest in index funds, invest in mutual funds, because it will shield you from those types of effects. All right, this one's key. Please don't ever invest in anything you don't understand. It's just don't do it, because here's what tends to happen when you don't.
Sorry.
He's about to tell them.
But supposing you have somebody who understands what you don't understand.
It depends on how much trust you have in that person. Because here's the thing, I've learned when it comes to investing in money, I trust no one. I mean, and when I say I trust no one, even some of the financial analysts, they'll be like, stock upgrade, stock downgrade. They really don't know. So I have a methodology and a process into how I choose stocks to invest in. I have the slide in here, but please don't invest in anything that you don't understand. What tends to happen is that when a stock drops, if you don't understand the company, the industry, why that stock drops, you'll be afraid and you will sell that asset because you have no idea why it's dropped and you don't have no idea what the strategy is to turn around.
Yeah. Mind if I ask you something?
Yes.
How will you respond to this question? And I think I might have asked you before, but I don't remember your answer. How much of what some of these financial experts predict is driven, by their politics?
Analysts?
There were people who said if Trump won, sorry guys, we're just talking here. If Trump won, the market is going to lose, $1 trillion. It's going to be catastrophic, and much of their analysis, today, from what we now know, was not driven by actual facts and data. It was driven by their animals.
So you have to there are what you're talking about, people who actually go out there and they'll talk to news, etc. Right? What?
Like Friedman.
I don't know who that is.
Oh wow, you don't know.
But there's some true analysts that will help you to understand the nature, the valuation of a stock. Now, maybe you're talking about economists. There are economists who will tell you what they believe is going to happen, right? With regard to the trade war, people can be like, economists got it wrong. Not necessarily. So they are looking at the effects of different things on the market. Let me not even say on the market, on the economy in general, right? So if you think about why did Jerome Powell cut interest rates? Well, it was because the market was hurting because of the trade war. So the cutting of interest rates influx the market, or influx the economy with more money. So people were even able to borrow cheaper to stimulate the economy. Because what you started to see were some of the companies telling you that they would not be able to post record profits because their costs are higher, et cetera, et cetera, et cetera. So everything is connected, but I don't think it's more of, I'm just going to go out here and downgrade this stock because I don't like Trump or because I love Trump. So that maybe I'm from an economic perspective, but I don't think that a lot of them do that. Okay, so let us look at diversification. I'm not going to spend a lot of time here. So you need to diversify your portfolio.
When it comes to the stock market and markets in general, it's about money.
Yeah.
And people love money more than politics. So, and I think that's a distinction. An economist looks at more like macro effects.
Yes.
But true people who are watching
Who are analysts, yeah.
Analysts, true analysts, they don't care about who's president or who's,
Yeah.
well, they might care.
Only to get taxes or tax cuts.
All anyone cares about for market folks is how can I make money?
Yep.
So then how?
So I'll be
and
less
I
inclined.
need to let you go.
So
Yes, you
I'm
do.
less inclined for true market analysts, I'll be less inclined to think their evaluations will be colored by their politics. Why?
Yeah.
Because they're more so about making money than who cares.
What Trump or not Trump is doing.
But Krugman's who you speak, and he's an economist. Paul Krugman.
Yeah.
He's an economist. He's not.
I mean,
Isn't-
he had some of the wackiest stuff.
Yes,
We
D.
got to let Loretta run.
All right, so best way to diversify. So you diversify by your asset classes, stocks, bonds, short-term investments. You can diversify by size. So I'll show you diversification by market cap. You can diversify by industries. So saying that, let's say you're invested into the software industry, you're invested into the defense industry. One of the industries that I actually just invested in because I believe it's going to be big is cybersecurity. So you can invest into cybersecurity. So you can diversify your portfolio by that. And then you can also diversify geographically. So I can invest in stocks, in international stocks that are based in Europe, China, maybe Middle East, etc. So these are some diversification strategies that you can go with. All right, so I'm not going to spend a lot of time on taxes. The only thing that I'm going to tell you guys is if you're making money in any market or instrument, you're going to pay taxes. It's just the amount of taxes that you're going to pay, right? So you want to be cognizant of trying to limit or reduce your tax liability. So that's why a lot of people talk about capital gains versus not, or capital gains long-term versus short-term. But for the most part, it's all about reducing your tax liability. All right, I already said that. All right, so investing guidelines. So we talked about this. Never invest money that you need in the next 3 years at minimum. If you need that money in the next 3 years, do not put it in the market. I had somebody that I talked to, and he was trying to hold out. He was like, "Oh, I have this bill that's coming up, and I'm trying to figure out the market's a little bit down, but I think it can go up. But I don't know if I should sell now or wait till it goes even further to sell that." No, if you have a bill that's coming up and you need that money, you don't know what the market is gonna do. Do not leave that money in the market. All right, step number 1. I'm going to now start mapping out how do you put together an investment strategy. The first thing is that you need to understand your risk profile. You must understand your risk profile. So are you conservative, moderately aggressive? I'm an aggressive investor. Aggressive, yes, and that's my father. My father takes the bulls by the horn. So you got to understand your risk profile. And your risk profile should correlate with your time horizon, what you were saying, Uncle. If you need the money in the next 10 years, don't go investing it in super risky assets because you need to make sure the money is there in 10 years, okay? If you are young and let's say you don't need the money for another 20, 30, 40 years, right? You can be a little bit riskier with your investment selections because you know that if the market tanks, you still have time for it to correct itself, okay? So the first thing you have got to understand is your risk profile. What that is going to help you to do is to develop an asset allocation plan, okay? So we talked about investing in funds, but your asset allocation also should be reflective of your risk profile. So what does that look like? The first thing that I always look at is what is your equity to bond split? Meaning that, and it's not, when we say equity, right, stocks are equities, you can use them interchangeably, stocks and equities. Mutual funds that invest in stocks are also considered equity instruments, okay? So because they're considered equity instruments, they are part of how you figure out your asset allocation. So for me, I only invest 10% of my assets in bonds, 10%, 90%. I didn't catch that one. 90% are in stocks, 10% is in bonds. Okay? Based on the stock asset allocation, so wait, let me cover the bonds. The bonds, I just buy one bond fund that invests primarily in investment grade bonds, and that's it. I think it's FBNDX. I have it in here. I'll show you guys. And with the 90% in, in stocks, right? I have an allocation that breaks out between large cap, mid cap, small cap, international, and also real estate. Okay? So, part of the reason why we went through this definition is so that as I'm saying it, you know what I'm talking about.
Could you say it again?
Yeah. So large cap companies over 200 billion, mid cap companies, small cap companies, international companies. So these are companies that are not based here in the United States, and then also real estate.
Okay.
Those are the five that I break it out at. So if you look at my portfolio, it's a total of 6. Bonds, large cap, mid cap, small cap, international, and also real estate. The one thing to remember is that if you think about it, the larger a company, the less likely they are to fail. That's in general. I'm going to use generalities and quote, right? That's a typical rule. The larger the company, the less likely they are to fail. Okay? So, yeah, I know. And Ron, that's why I said I'm using that in generalities, because you got exceptions to those rules. So the reason why I tell you that is because the large cap companies, when I do my asset allocation, have more allocation than a small cap company. If I wanted to be super, super risky and I find a small cap that is blowing out the water, I can say maybe that one has more allocation. But because I know my risk profile, the large cap has a bigger allocation than a small cap. All right? So let's look at, this is my personal 401k allocation. So those are the ones that I invest in.
Sorry, can you go back one slide?
Yeah.
Okay, yeah, short term, right?
Say that again. Oh, short term. So short term you can think of that as like cash. Yeah, short term interest. So I have in my, I might have pulled this. I actually have cash. I keep 10% in cash, so that if the market goes down, I can actually make a move. Yes, exactly. I can buy something. But thank you for reminding me, because cash is actually part of your investment strategy. So in your 401k, you can't have cash, right? But if you are investing outside of your 401k, you do think about cash as part of your investment strategy. So this is my asset allocation, right? The reason I have 2 large cap is because I have 2 large cap mutual funds. I invested those at 10% each. So the total large cap is 20%, mid cap is 15%, small cap is 15%, international is 10%, real estate is 15%, software is 15%, and bond is 10%. That's how I break it up. And that should equal to 100%. So that's how you do your asset allocation. You guys all following? Okay, say that again.
So this is your 401k, so you actually mess around with your 401k.
No, personal.
No, this is my 401k. Yeah.
It's personal, not the...
You can do it for your 401k, because so when you I'm not going to open my 401k. Although they give you a set of 30 mutual funds, they tell you what those funds are. So they'll tell you if it's a large cap, large blend, mid cap, etc. So I just follow, I know I want to invest mostly in large cap companies, so I find a fund that within those however many 4 that they have, that is a large cap, then I find mid cap, then I find small, international, real estate, etc.
I thought you were sharing your IRA.
No, my IRA is very complicated. All right, so we talked a little bit about concentrating. This just shows you, I think these are the two funds which I was invested in. So the T. Rowe Price Blue Chip Growth Fund. So you see here on the right, it was Amazon, Microsoft, Facebook, Google. And this top 10% resulted in 40, you see the top 10 holdings are 43% of the account, or of 43% of the mutual fund. And I invested in this one too. And you can see it's the exact same companies. And they had the same, so I was basically concentrating my portfolio. All right, so the tip number 10 I wanted to tell you guys is that diversifying your portfolio does not mean you need to invest in a lot of funds. Because a lot of people think, oh, I just need to go get like 20 mutual funds. You don't need to, because those mutual funds are already diversified. So just something to think about. Make sure you diversify, whether it's across industries, across capitalizations, across regions, right? But that's how you really diversify a portfolio. If all of this is overwhelming, invest in a target fund. The majority, all brokerages have target funds. And what you'll see is that you'll see a target fund, maybe it'll say target 2050. Yeah. And basically what they'll do is that they assume that your retirement date is, or you need that money by 2050. So they invest in the mutual fund according to a profile of when you need the money by 2050. Okay, so if I invested in a fund that of 2025, you'll see that the fund is not moving as much, right? But that's because they're assuming you need the money in 5 years, so they don't want to be risky with those assets. Does that make sense? Mm-hmm. Okay, good. All right, step 3, develop an implementation strategy. This basically is the act. There are 2 ways which you can implement your strategy, right? Let's say I had this, give me this example, the dollar cost averaging, right? I had $4,000 to invest. I can take $4,000, I can invest it all at one time, right? And buy whatever assets I want to buy at one time. The other way I can invest for $4,000 is to say, okay, I'm going to employ a dollar cost averaging technique. And what this does is that I spread out the amount of time when I buy the stock. Because you don't know what the stock is going to do. Maybe sometimes it's going to be high. Maybe sometimes it's going to be low. So on and here's where I gave you an example. So January 1st, I invest $10,000. At that time, the price of the stock was $25. So I bought 40 shares, right? April 1st, I invest $1,000. The price of the stock is $31, so it is 32.26. You can't buy a fraction of a shares of stock, but this is just to make the example easy to understand. Then on July 1st, another $1,000. This time the stock is at $20, so the number of shares I buy is 50. And then the last one is October 1st, so the price was $1,000. It was, I invested $1,000, the price is $35, so I invested 28.57. If I average the amount of shares that I have by the total cost, the average cost I paid was $26.52, okay? That's the dollar cost averaging. It just means taking the amount of money that you had and investing it over time. When you're putting your money in your 401k, you're doing a dollar cost averaging technique, right? So just something for you to remember. All right, so other investment strategies that you can take a look at. So you can do value investing. So remember, value investing is investing in assets that are undervalued. This is what Warren Buffett is really, really famous for doing. You can do dividend investing. So this is investing in assets that regularly pay out dividends. You can growth investing. This is investing in stocks that have great growth potential. And you can do momentum investing. One of the things that I wanted to tell you guys, because sometimes people get scared about stocks, because I think I have that in the, but you know more about companies than you think you know. You really do. So give you an example. Does somebody have $40 in their wallet right now? Anyone have $40?
Don't carry cash.
Exactly. You don't carry cash. Why?
Just a habit.
Yeah, but I'm saying we're going to a cashless society, so what do you use instead? Your cards. Okay, so you're charging it, but who's making money? Thank you. So if you're going to a cash, so Visa's making money. How about if you, part of the reason why I invest in Square is Square is actually Cash App. PayPal is Venmo. If as we've gone to a cashless society and you have a lot of millennials, you go out and eat and be like, oh, I don't have cash, but I'll just Venmo you. What's your little, and then you just send them the Venmo, right? That's where we're moving. So you actually know a lot more. Say that again. They're a lot. I know. But even the boomers don't carry cash. My parents hardly have any cash on them. So it's just something to think about as you're evaluating some stocks. All right, rebalance your portfolio twice a year. Okay, rebalancing your portfolio, because I talked a little bit about my asset allocation, right? So let me do this, see if I can do this really quick. I'm just, for roundness, I'm just gonna say large cap, mid cap, small cap, and then real estate. This is just an example. This is just a quick example, right? Money. 25%, because we're looking at asset allocations, right? So as you have assets in here, they're going to grow or reduce, right? You want everything to grow, but maybe everything is not going to grow even at the same rate. So the reason you rebalance your portfolio, maybe in July, this has gone from 25% to 30%. This one has shrunk to 20%. This one has stayed the same to 25%. And I can't do math, 50. And this one is 25%, right? This is what my portfolio is. When I rebalance, right, all I'm doing is I'm saying, okay, I want this to go back to large cap, 25%, etc. Okay? I'm saying that I'm going to take the gains that I've made here, and I'm going to probably buy some more of this mid cap, which is low, right? And these ones are basically staying the same because it's still at 25%. So rebalancing means you're balancing your portfolio and you're going back to the original asset allocation mix that you have. Does that make sense? All right. So that's also something that you guys should do twice a year. Rebalance. So this is a very good tip. So one of the things they talk about is the fact that you need to raise cash when you don't need it, so you have it when you do need it. All right? Meaning that if you want to raise cash, you raise cash when the market is high, so that you have it when the market crashes to actually buy some assets. All right? So raise cash when you don't need it, so you have it when you do need it. Yes, yeah. Because a lot of times what will happen is that when an asset is going high, you don't want to sell it because you think it can go higher. So, and the thing is that you don't have to sell everything, but you can sell a portion of it and make sure that it's balanced. So that even your cash can be part of your asset allocation. Okay, 12 ways I analyze a stock. We didn't really look into stocks because I always tell you guys to really focus on investing in mutual funds and in index funds, but these are going to be available in the slide set deck when I send it out. So you guys will have it, and if you have any questions, let me know. Okay, final things to remember. Try not to fall. Investing is a long-term journey. It is not a way for you to get rich quick. If you're trying to get rich quick, you will make very, very silly mistakes for the greed aspect of it, greed and fear. So what you've got to do is that you've got to look, even as we talked about from the first class to now, Your goal as an investor is to look at the potential impact of every single dollar that comes into your wallet. That means everything from, do I service a loan that I have? Do I pay off this loan? Do I invest this money? Do I keep this money as cash? There are lots of things that come into play when you're thinking about investing. Remember, we talked about the idea of making sure that you always have 3 to 6 months of emergency cash available at all times, no exception. Always have 3 to 6 months of emergency money. If you don't have 3 to 6 months of emergency funds, then should you be investing at that time? If you're in a retirement account, yeah, you should be, because you want to make sure that that money grows. But if you're doing personal investment, does it make sense? So, and then the other thing you've got to balance out is if you have debt. So that's why, this is part of the reason why from the very first class we covered the whole aspect of saving versus paying off debt versus how to invest. Do you have kiddos? Like, they got 3 right now, right? You got to send those kids to college, right? So what are they going to do to send those kids to college? So it's looking at all those things. And the other thing I'll tell you guys is you want to prioritize your tax sheltered accounts. Why? Because they're tax shelters. You're not paying taxes on it. So it's a way for you to get free growth on your earnings, or free or tax relief on your growth. The other thing I want to tell you guys is that you'll make mistakes along the way. Once you do, don't be like, I'm never doing this again. You learn from your mistake and you move on. I told y'all about my $1,500 mistake. I promise you I'll never make that mistake again. I will not make that mistake again. The other thing to remember is keep your emotions in check and stick to your strategy. The whole thought of fear versus greed, when you see the market tanking and you're like, oh my God, my life's about to be over, just don't look at it. Keep your emotions in check, all right? And always remember, what you probably should be doing is the opposite of what your emotions are telling you to do. If the market is flying high, you're like, no, I want to hold on. You might want to think it might be time to liquidate some of the assets and get some of the profits. Let me tell y'all. So I have Apple stock. I bought into Apple. My story about Apple is long, and we don't have time to go into it. But the recent ones that I had, I bought some of them at like 150 and 178. The stock is over 300 now, but I remember when it got to 275, I put in a limit order to sell at 275. And I was just telling myself, like, do I really want to sell? Like, it can go higher, it can go higher. And I was like, Loretta, you know better. Yes, yeah, so you know better. Just take the gains and go do something, go do something with that money, because that was my strategy, right? So stick to your strategy. But if you do make a catastrophic mistake, don't think the world is over. Just learn from your mistake and adjust.
Can I ask you something?
Yes.
Now, you said that when you're selling a stock, you're selling to a person.
Yes.
Suppose
There's nobody to buy it?
Yeah.
It doesn't. The order doesn't execute.
Really?
Yeah. Oh, sometimes what you'll see is that for smaller companies that don't have a lot of outstanding shares, it takes a while to be able to move maybe a few shares of that stock. Yeah, so the order doesn't execute.
Wow.
All right, so the other thing to remember, you can't time the market. Don't try. You don't know if the market's going to crash tomorrow. You don't know if it's going to stay up. I can tell you what I speculate about the market. I don't feel like it's going to crash this year, although it's crashing right now. Why? Because it's election year. So that's just my opinion. It could crash, but again, don't be like, oh, I'm not going to buy in because I think a crash is coming. You can't time the market. And then the last one is a market correction or a recession is an opportunity. So just always remember that. So the last thing I'll leave you guys is with some additional resources that you can go to read at your leisure. I'm always reading articles and stuff. These are the places where I tend to get a lot of my articles from. I just finished reading The Simple Path to Wealth by J.L. Collins. It was actually a really, really good book. It talked a lot about what we've talked about, but the way he does investment, he talks about 2 different assets to purchase. He talks about buying an asset that basically takes a fund that calculates that tracks the index for the total market and a total bond fund. So total market and then total bonds. But beyond that, I think that it's actually a really good book. So that's one that I would say to check out. So with that, I just want to say thank you guys for your participation. I hope you guys learned a lot from the sessions. Like I said, I will be around till about 1 o'clock to help you guys if you have some questions, if you brought in anything you guys want to talk a little bit more about. Tim is actually out there in the back. He was the one who did the real estate session. So if you guys have additional real estate questions, definitely please let him know. And as always, my mom is handing out some handouts because we're trying to improve this class. So if you don't mind giving us your feedback, write in some comments. There are things you wanted us to cover that we didn't cover. You thought it sucked. You thought it was great. Any feedback that you have will be. So, I know. But, so just provide us your feedback would be, I'd really appreciate it. Dad, what is, you in this music? But I know. Yes.
There was a question I was going to ask, and I said I'll leave it till later on. I'm just wondering, your rate?
My rate?
Your real?
Yeah, my rate?
Yes.
Yes.
I just wonder, is there a way one can set up one for oneself, not exactly a rate, but some sort of vehicle that's got the features?
Of a REIT?
Yeah, of a REIT. Is that possible?
You mean have an investor or somebody who manages a REIT who goes and buys property and then some people invest? Is that what?
Have one that you do that yourself.
You do? Oh yeah, you can, but I mean you've got to go through the SEC and you got to make sure that you're following the line. Yeah. It's basically the same thing as listing a mutual fund or all that. Yeah. Okay. Alrighty, so with that, thank you guys very much. I really appreciate your participation, and hopefully you learned something. And I think for me, the biggest thing is to help you guys be empowered to take your next steps in investing and really start to have the mindset of thinking like investors. So hopefully we were able to do that. And if you guys have any feedback, questions, we'll be here. So thank you guys.
Thank you, Loretta.
I just want to commend you on your very nice looking slides.
I'm in marketing. They'd be disappointed if it wasn't nice.
They look like pro slides.
Oh yeah. So I took the pros template and then I changed the master slides. Yeah. Yeah. I took the pros template. So she's right. I was like, I can create my own template, but why?
Do you have some food there?
Yes, please. We still have food, so eat.
So Loretta, how did you, of the 6 stocks that you picked, how did you do the split? Did you follow a formula like from the book you read? Versus like if you're 40, you should do 15.
Oh, you mean my 401? Oh, thank you.
15 for small cap, 15 for real estate, blah blah blah.
Oh, so it's based on it honestly is based on my personal. It's based on what I wanted to do, and then the other thing that it's based on is looking at the returns of the company over time. So, like last year, the large cap companies did really well. So I looked at those returns, but I'm like, I can't put all my money in the large cap, so I want to diversify into mid cap and also small cap. So then I was like, okay, how much do I want to diversify? So then I said 15%.
Okay, so it's just kind of arbitrary.
Yeah. But the fact of having only 10% in bonds, that was a decision by me to only have 10% because I'm more of an aggressive investor.
Person.
Yeah. So,
Everything, it doesn't
yeah.
work.
Oh, uncle. So I was talking to Auntie, and I wanted to have you guys chat with Tim a little bit later. So, with regards to real estate, so
The thing is, why I'm there, I've been reading a lot about commercial,
property,
not just
yeah,
real estate, generally, commercial, and in particular, multiple units, properties,
Yeah.
like an apartment block.
yeah, yep.
I think that's, from what I'm reading, that's where the good money is going
Oh,
to
he can
at the
tell
moment.
you all that.
And I just wanted to talk to somebody,
yeah.
more about the funding side of it,
Yeah.
and the whole
All that.
shebang.
Yeah. No, he can definitely, because I can't tell you
Yeah.
that piece of it. I can't tell you. But
Thank you, sir.
Dad,
Because the bank lets you have to make 5-year payments. They might struggle making the payments. So you might step in. So something
Yeah.
to consider. Hey,
sorry, Tim. I wanted to introduce you to this is
This is my man.
this is Uncle Peter, and then that's a.
Are you hungry?
What's wrong?
He wants candy, and I said no. And I said no. And then he said